Hey everyone, in today's video we're diving into Financial Literacy 101, all the topics that should have been taught in school. Financial literacy is simply understanding how money works. It's knowing how to budget, save, invest, manage debt, and plan for your future. You don't need to be a financial expert. In fact, you don't even need to be good at math. You just need a solid foundation so you can make smart decisions, avoid costly mistakes, and build financial freedom. Let's start by keeping it simple. What's the relationship between how money comes in, your inflows, and how money goes out, your outflows? Your inflows are your income, your paycheck, side gigs, and investment income. Your outflows are all the things you spend money on, like rent, food, debt payments, entertainment, etc. And the relationship between the two is called your cash flow. Financial literacy starts with understanding your cash flow because it's the foundation for everything else. Are you spending more than you make? Are you living within your means? Do you know where your money goes each month? Do your spending and savings habits match your goals? If the answers to these questions aren't where you want them to be, start by reviewing everything you spent last month and adding it all up. A great beginner-friendly budget method is the 50-30-20 rule. Spend 50% of your income on needs, 30% on wants, and 20% on saving and investing. Budgeting is not about spreadsheets or complicated math. Those are just tools to help you make better decisions. The real decision-making happens at the checkout counter or right before you click purchase online. Next up is your emergency fund. When it comes to finances, you should always expect the unexpected. Life is unpredictable. You could lose your job, cars break down, medical bills pop up. An emergency fund is the buffer between you and the unexpected. Most experts recommend saving 3 to 6 months of living expenses. If that feels impossible right now, then you can start smaller, like $500, $1,000, or 1 month of expenses, and build from there. An emergency fund doesn't prevent disasters, but it makes them more manageable. Next, let's talk about debt. Now, debt doesn't have to be complicated. It's simply money you owe, whether to a person, a bank, or the government. And here's how it ties back to budgeting. If you spend more than you make, eventually you'll be forced to go into debt. So before you focus on paying off your debt, you should first address the behavior that got you there in the first place. Debt is especially dangerous because it kicks you when you're down. If you're borrowing money, it means you already can't afford something, and then it forces you to pay a higher amount for that which you cannot afford. It can be devastating to households. Here's my golden rule of personal finance. Only use your credit card for things you can pay off in full, on time, every single month. Credit card interest is no joke. Most cards charge 20 to 30%. So the goal is simple. Use your card for convenience and rewards, but do everything you can to stay far away from carrying a balance month to month. But let's say you've fixed your spending habits and you're ready to start paying off debt. There are 2 proven strategies. The first is the snowball method, in which you make minimum payments on everything, but throw all your extra cash at the debt with the highest balance first. This gives you quick wins to help build momentum. Or you could follow the avalanche method, in which you also make minimum payments on everything, but you throw extra cash at the debt with the highest interest rate. This saves you the most money over time. Both methods work, so I recommend just picking one and sticking to it. Now let's get to the fun stuff, investing. Investing is how you grow long-term wealth through compound interest. Saving alone usually won't cut it because inflation slowly eats away at the value of your dollars. The good news is you don't have to be a stock picker to do well in the market. You can build long-term wealth by buying low-cost index funds consistently and holding them for years. Historically, the US stock market has averaged over 10% return per year for over a century. You don't have to beat the market to win. You just have to stay invested for long periods of time. Now, this isn't specific investing advice, but some of my favorite index funds include ones that track the S&P 500, like VOO, ones that track international stocks, like VXUS, and ones that track bonds, like BND. But your actual portfolio should be based on your own timeline and risk tolerance. Stocks are risky, but that risk is what creates higher returns. Think of risk as the price you pay, and compound growth as what you receive in return. You can't have growth without volatility. Finance people call this the equity risk premium, but in reality, it just means no risk, no reward. To be successful at investing, avoid the common traps. Don't try to time the market. Don't panic sell when stocks drop quickly. Don't chase individual hype stocks. Don't wait until the perfect time to start investing. Time in the market beats timing the market. Our next topic is credit, specifically your credit score. Your credit score is your financial reputation. It affects your interest rates, your ability to borrow, insurance premiums, apartment applications, and sometimes even job applications. Your score is built on 5 key factors: payment history, credit utilization rate, length of credit history, new credit inquiries, and credit mix. To boost your credit score, keep your balances low, always pay on time and in full, and avoid unnecessary credit checks. And here's a simple tip I always recommend. If you're not planning to open a new line of credit anytime soon, you should freeze your credit with all 3 major bureaus. It takes just a few minutes and makes you way less vulnerable to identity theft or someone trying to open accounts in your name. Next up, let's cover where should you keep your cash savings. It needs to be in a safe place, but it also needs to earn interest. Look for a high-yield savings account or a money market fund. Most big banks actually pay almost nothing on their standard savings accounts, so shop around for a better rate. Don't let your money sit there just doing nothing. Lastly, I want to leave you with this. Don't fall into the trap of financial avoidance. That feeling when you're scared to even open your banking app or credit card statement because you don't want to face what's in there. Any situation can improve with small, consistent steps in the right direction. Financial topics are often made to sound complicated on purpose. The more confusing they seem, the easier it is for others to take your hard-earned money. That's why financial literacy is so important. If you found this video deserving, please hit that like button and subscribe to my channel. Thanks for watching, and I'll see you in the next one. Take care.